Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Financial management is not just about how much money you make. It's also about how much you save, how hard you make it work for you, and how many future generations you keep it going for. Hello and welcome to the Mutual Fund Day Family Financial Plan series, a show that chronicles different financial planning case studies of individuals with unique financial backgrounds selected from different parts of India. This episode is no different. Our featured investor today is Hemal Patel, and joining him is Pranav Patel, his financial planner, and we are here at Anand, India's milk capital. So let's start by taking a quick look at the rearview mirror of Hemal's financial planning journey.
In today's episode, we will be looking at the financial planning journey of Hemal Patel. Hemal comes from a family of entrepreneurs, and it was his father who introduced him to the world of investments.
Initially, my father started investing firstly, and he bought a quantum of 25, 50, 100 shares, and over a period of so many years, they have now grown in multiple folds.
There was a totally different concept about my father-in-law. He always thought that girls are better investors and they can manage money better than their boys. So the very first day he told me that instead of joining any firm or any institute, you can join us in our own factory. So they wanted me to take care of the finance part.
An entrepreneur himself, Hemal's company Tripcon is into the manufacturing of heavy machinery. He stays in Anand with his parents, his wife and their 2 kids. Although the family has been investing in the equity market for decades, Hemal started his own investment journey into mutual funds almost a decade back.
I joined investing in around 2008, and we diversified then investing in various kind of mutual funds and balanced funds and diversified funds. My friends, they told me that it is good in investing in mutual funds, and when I joined there was a huge crash in the market, so around 2008. So at that time a lot of people were believing that to safely invest in the market and to grow your money, you need to invest small amounts in mutual funds, and then gradually we started SIPs also. So that is how we began our journey in mutual funds. We have invested into fertilizers, we have cement stocks, we have companies who are in steel manufacturing, then road construction, infrastructure. So we have invested in all diversified. FMCG is also there.
With a very well diversified investment plan in place, Hemal is all set on his way to achieve his financial goals.
Short term, we have categorized into 3 categories. One is emergency funds, where we have make provision for unplanned expenses, wherein somewhere either medical expenses or any emergency tours overseas or anything like that. And second is our vacations. Normally we take break in 2 breaks, one in March or April and second in Diwali. So we have planned for our vacations and for donations. Whenever there are times we need to help the community in any kind of relief funds, we have made provision for that. Our children's further education, their marriage, and our retirement plans, and for the legacy also. So when children they grow up and they want to start up their own enterprise, so there would be a corpus available to them to for their use in their enterprise and move ahead in business.
All right, now that we have a broad understanding of Hemal and his family's financial planning journey, let's take a short break. On the other side, we'll be decoding his balance sheet, and to help us do that, we'll be joined by Pranav Patel, his financial planner. Stay tuned to CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. In the previous segment, we got a broad look at Hemal Patel and his family's financial planning journey. In this segment, we'll be taking a deeper look at his investments and goals and the way ahead. And to help us do that, we're joined by his financial planner, Pranav Patel. Gentlemen, thank you so much for joining us. Hemal, your family has quite a history when it comes to investing. Your father started investing directly in stocks in 1982. I keep hearing all these stories that if you had bought stocks 30 years ago, worth say just 10,000, they would be worth hundreds of crores. So tell us about this journey that your father had.
Firstly, he started in his 20s, he started investing in stocks, and from there on, it got multiplied.
Now, you started taking investment decisions 10 years ago. What lessons did you learn from your father's stock investing experience?
Some of the shares, when they got multiplied, and I heard that we had in past 100 of them, and today we have it in 5,000 and 7,000. So I got interested much that I told that I also want to invest more. When we are having good funds, then we'll be looking for some broader perspective, and with the different companies we can invest.
Okay, now investing directly in stocks is not for the weak of heart. Now, you started investing in mutual funds in 2008. That's around the same time you actually got into investing overall. So was investing in mutual funds your decision?
Yeah, investing in mutual funds was my decision.
Okay, and how did you manage to convince your father that it was the way to go? Because he obviously has a higher risk appetite, considering that he went through the rough and tumble.
That again was a tough call to convince him to park funds in mutual fund. But when all the pros and cons were described to him, then finally he got convinced and said, you can start from a bit. So then we gradually started parking, and we kept on.
Okay. Now, Pranav, a quarter of Hemal's financial portfolio is invested directly into equities. Now, are you comfortable with that risk enough to, keep the ratio as it is, or do you think it should be a part of it is going to be shifted towards mutual funds, which are a more safer option compared to directly investing in stocks?
As part of our strategy, we have been planning shifting a lot of funds from direct equity into diversified and balanced mutual funds as and when our goals are coming to nearing their ends. And initially, as uncle started investments into direct equity, he was not very comfortable with selling those stocks and getting more of the mutual funds at the early stage itself. But now when he's seen the progress into mutual funds as well, yes, there hasn't been a conscious I would say effort to not do that, and we have been gradually shifting from direct equity into mutual funds.
And what sort of target would you set? Say his investment in mutual funds is around 5% of his portfolio, while investment directly in equities is around 25%.
Right.
So how would you look at paring that down? Say 15% levels for direct equities and then bring up mutual funds?
We are planning to shift almost at least 10% more from direct equity into mutual funds.
Okay. Now, he has a well-funded portfolio, but a large portion of that is still in real estate. So is that an investment play? Because isn't there a risk there, and would you be looking at changing that as well?
Not really, because they have been businessmen since generations now, and as I know, his children are also going to be businessmen if they want to, but most likely they are going to be businessmen. So that has been a conscious effort to have a land banks and real estate properties, so that when they want to get into businesses, they have these land banks so that they can start their own factories and all this stuff.
All right. For new investors looking at debt funds as an option, what are some of the do's and don'ts that you would recommend?
For retail investors, I would like them to understand that they should not just chase the YTMs, and it's better to have a proper diversified debt fund which has a AAA, AA, G-Secs and all this stuff. and instead of just chasing the YTMs.
All right. Now let's come to Hemal's case study. Pranav, how is his investment portfolio structured to meet his short-term goals?
For short-term goals, we generally invest into liquid funds and ultra short-term funds, and very rarely we go for short-term funds as well, which has a horizon of around 1 year. And they generally do keep on investing every year in their emergency funds as well. As his parents are also old now, but they're still active, but they just want to keep on increasing their emergency fund so that whenever it's required, they have a huge corpus for that as well.
All right. And for investors at home, how does one go about choosing fund options to meet short-term goals between, say, a liquid fund and an ultra short-term fund? What are some of the key things to look out for there?
I would say for ultra short-term funds as well, do not go for funds which are having more GSECs, I would say, because they bring you more volatility. A lot of funds, short-term funds, are showing good returns because they manage their bonds well. But I would say if you don't want volatility, go for funds which are not having more of GSECs and more on the lesser horizon papers. And that should meet up your short-term goals.
All right. And Hemal, do you have an emergency fund in place in your portfolio? You run a family business, so any business has ups and downs. So do you have an emergency fund in your portfolio?
Yeah, we have emergency fund in our portfolio.
And how has that been structured for him?
Majorly into liquid funds.
Okay.
Yeah, the major part of the emergency funds are invested into liquid funds.
All right. And any key pointers for investors at home when it comes to structuring an emergency fund?
Liquid funds is the best thing I would say for creating an emergency fund, because in the new era right now, the technology is helping us for instant redemptions as well. A lot of AMCs are giving us instant redemptions. So, I mean, just by a click of a button and you have a good sizable amount into your bank account within half an hour as well. So that's a very good thing for having an emergency fund as well.
And what do they need to watch out for when they invest in these liquid funds? And then some of the issues that they need to avoid, which you feel that it would be in their interest that when they are looking for options from liquid funds, what are some of the red flags that you would point out to them and say that this could be an issue, go for this?
Well, I would say just stay with pure liquid funds for emergency funds and not the liquid plus category, which generally a lot of IFAs or agents are selling about. But pure liquid funds give them a consistent returns without the volatility. So just don't chase the returns of liquid plus category, which gives spikes of returns when the rate cuts are there. But just go for standard liquid funds.
All right. On that note, we'll take a short break on the Mutual Fund Day Family Financial Plan series. But stay tuned. Lots more insights on money management coming up.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. We are on the last leg of this episode, so let's pick it right off with our guests. Now, coming to tax planning, how have investments of Hemal's portfolio been structured in terms of tax efficiency? His father has invested a lot directly in equity. So, for the purposes of for understanding of our viewers, could you tell us how the tax planning has been done for Hemal's investment portfolio?
As you said, his lot of around 20-25% is in direct equity, and majority of the stocks are long-term investments. They've been holding it for like 20-30 years. But as the regulations of income tax right now are that if you hold direct equity for more than a year, they are tax-free for you. So major part of his portfolio is tax-free for them right now, as they've been holding it since long. The same thing is with their mutual fund portfolio as well. They've been holding equity portfolios for more than a year now, and all those are tax-free for them. As again, equity mutual funds are tax-free after 1 year as well.
Now, when we talk about tax and funds, ELSS obviously comes into the forefront as an investment option. But again, the benefit lasts only till 1.5 lakhs. But I've noticed and I've actually read about it online that ELSS funds have actually done really well over the past 1 or 2 years, especially when compared to regular equity funds. And some of the mutual fund advisors have also been surprised at the demand for ELSS, not just as a tax saving measure but as an investment vehicle. So what do you think explains this appeal of ELSS as an investment vehicle?
ELSS is a very good category for long-term investments, and it's not only about tax saving, but yes, a lot of investors do invest only up to 1.5 lakhs because they see this as just a tax saving tool. But I would say even if you have a long-term horizon, if you have a lump sum money to invest for a longer run, you just need to know that it has a 3-year lock-in period. But if you keep on holding that for long, you really make good money. As even the fund managers of these ELSS funds know that these funds are here to stay. And at the markets at 10,500 Nifty, at least they will be also having a question that whether the lump sum money which is coming in, will it stay for 3 years or not. So if you really have a longer horizon, I would definitely go for ELSS, and I would even suggest an SIP in ELSS, because even though it has a lock-in period of 3 years from every month of SIP, but still if you have a longer horizon, if you have a horizon of 10, 15, 20 years, and ELSS is a very good tool for investment in SIP as well.
Alright, and in general for tax efficiency of their investment products, what are some of the tips you would offer to investors watching at home?
One of the advice which I've also given to Hemal Bhai's family as well is that when you are in the highest tax bracket, you need to see which are the debt funds or debt opportunities options you have, which is more efficient after tax. A lot of people are seeing pre-tax returns and comparing the debt options, but the better way is to compare the post-tax returns, and it changes from according to situation of individual tax slab of different investors. So an investor should definitely see that what is their post-tax return in comparison to other products, and then choose wisely which debt option they should go for.
Alright, Hemal, let's come to your long-term goals. Now you have 2 children and your long-term goals include 1 crore each in terms of education fund for both the children and 1 crore each for a marriage fund for both the children. So at what stage has the corpus reached for these targets? If you can give us a percentage sense of, if you had these targets, whether it's 50% up or 60%?
It's up to 50%.
Okay, and what do you think Hemal needs to do to meet these targets completely in terms of investments, structuring his investments? Right?
Well, I would say we've almost done everything, and he has achieved a lot of corpus already present for meeting these goals, and the SIPs which we are doing for these long-term goals are going to achieve all these investments targets which he has, and we've already completed all the plannings and all the investment options which he needs to do.
Right, and Hemal's is a unique case in the sense that his investment portfolio is well funded. So obviously from that perspective, looking at these long-term goals, these targets looks like very achievable. But for this category of investors, what are some of the pitfalls they need to avoid? Because for an investor who's just starting out to save for his children's education fund or marriage fund, sure, those pitfalls are already mentioned clearly. But for investors who know that they're very likely going to meet these targets, what are some of those last-minute pitfalls that you would advise to investors to avoid?
I would advise a lot of investors are getting details like they should invest into children funds or different insurance policies for children's, and I think they need to figure out the difference between long-term investing and the power of equity in long-term. And I would say if you really have an horizon of 15-20 years for your long-term goal to be achieved, you should definitely go for equity only right now. And you should not fall prey for different kinds of funds or which are not equity oriented, and just because of the name child in it, and you just should not follow those products for investing into longer run. So better is that you invest into diversified funds. You can also have a flavor of thematic funds. I mean, for example, pharma funds and FMCG funds, they're doing really well, fantastically well for a longer horizon of 10-15 years. So you can also have that. But choosing a thematic fund has to be very critical and very, I would say, selective as per an investor's risk profile, because they are a bit risky. And or they can also, if they want the risk to be less, they can always go for balanced funds as well, which are doing good for longer runs as well.
All right, let's get summary statements from both of you. What would your advice be to investors watching at home, watching this show, watching your case study? What would your advice be to them?
We need to save a bit and keep investing for the longer horizon.
All right, that's a key message, isn't it? Save before you spend.
True.
What would you say to our investors?
I would say, India was always been considered to be a savings-oriented country till now, and we've seen our elder generations emphasizing a lot onto the savings. But the new generation is shifting their lifestyles towards a spending economy, and we've been following the West. So I would I would suggest these new investors and new generation to save more or invest more, and you can always spend with the income which you generate from these investments, and the longer you invest, the longer you go.
All right, on that note, we'll conclude this episode. Thank you so much, gentlemen, for sharing with us your stories and your insights on money management. That's it for this episode of the Mutual Fund Day Family Financial Plan series. We'll be back with another financial planning case study soon. So stay tuned to CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.